There we go. Now we're recording. Sometimes I forget. It's me and the Ashleys. I know that's pretty funny. Good morning. Good morning to you. It's actually good evening to me. It's about 4 minutes to midnight. Well, actually, yeah, 4 minutes to 11 p.m. Since you guys have daylight savings time and I don't, then then you guys caught up to me by an hour this month. So I'm 11 hours ahead instead of 12. Yeah, it's pretty crazy. It can be kind of brutal depending on what my schedule is. Yesterday was kind of brutal because I went on a tour yesterday of Angkor Wat and a lot of ancient temples all day, which was exhausting. And then I had my office hours from 9:30 p.m. to 1 a.m. and then a faculty meeting from 1 a.m. to 2 a.m. And then I had to teach a finance class from 5 a.m. to 7 a.m. So, needless to say, I was ready for bed right after right after yesterday's activities. But you just get used to it, uh, living overseas. Welcome, William. We'll get started in about 2 minutes. I always like to start on time. So, well, in case you guys didn't know where Angkor Wat is, it's in Cambodia. So I'm in Siem Reap, Cambodia till April 1st, and then I take a flight, hopefully that won't get canceled, to Japan. So be flying to Japan, stay there for yeah, Cambodia. It's my first time in Cambodia, but it's been pretty amazing. The people here are probably some of the nicest culturally that I've ever met. Oh, not too far from Laos. Ah, very interesting. I met several nomads that enjoyed Laos. So I hadn't really known about Laos too much, but I got some recommendations on checking it out. So maybe in the future I'll be able to check it out. Welcome, Melinda. We'll get started in about 1 minute, actually. So we'll get started on time. Let me share my screen. Welcome. Okay, share my screen. That way you guys can see the agenda. I'm going to make sure that I have my chat window up so in case I see. Well, very nice access to Mekong. Ah, one thing that, of course, just watching nature documentaries, I've always been curious about are seeing some of the super large fish on the Mekong. Or I definitely want to take like a little boat ride on the Mekong. So I think that'd be fascinating. Siem Reap's a nice town. Definitely different from my time in Thailand and Vietnam over the last few months. Okay. Well, it is 12 noon precisely. Let me go ahead and make this a little bigger so you guys can see what the agenda is for today. It's same format we always use in Moneymakers Club. Those of you that haven't been, welcome. I am still the faculty sponsor for Moneymakers Club, at least for the next 6 months until we find a replacement. So I'm still happy to virtually sponsor the club. Uh, and it's been great. I really loved it. And I think all the members that we have really appreciated the information sharing, and it's totally student driven. Matter of fact, I'm going to write this right here. One of the we've we've had suggested in the past, I finally was able to put together a handout for today. So, especially since it's tax season, I thought it'd be a great topic to talk about. So I wanted to wait till this month to do it. Hey, Tatiana, welcome. All right. So, first thing, if you haven't been to Moneymakers Club before, I'm the sponsor, and we are a student-driven club. We were chartered in 2019. One of my students asked if I would be the faculty sponsor, and I agreed because I thought it was a great club idea. So we filled out our charter and got approved by FSCJ, and we've been chartered since. It was kind of funny because when we got chartered to December 2019, that was right before COVID. So we were meeting once a week, uh, both in the daytime and the nighttime at multiple campuses. We would take a look at live trades when the market was active. But since then, or since COVID, we've basically had our meetings once a month, uh, mostly live, but in recent over the recent year since I've been out of the country, then we've been having them virtually. But the club's still going strong. Matter of fact, our first club president, she actually was a dental hygiene major, so she wasn't even in the business program, but thought it was a great idea. So if you have students who are interested in this stuff, whether they are familiar with investing or not, invite them to come because it's totally free. All you need to do is just be a student or alumni to come to the meetings. And again, student driven, and it's an information sharing club. Meetings are only an hour long once a month. And starting next month, they're actually going to be face to face live. So I'm going to try to at least have two meetings a month while I'm in the States. So I'm going to try to have a daytime meeting to accommodate those that can't make it at night, and have an evening meeting for those that can't make it during the day. And I usually try to have them at different campuses to accommodate different parts of town, just because Jacksonville is just so huge. So I'll hopefully have those through August face-to-face meetings. And if I'm in a technologically accommodating room, hey Teresa, then hopefully I'll be able to stream the meetings live too. So which has been possible whenever I've had it in the FinTech lab over at Kent campus. So that's worked out pretty good. So let's dive right into it. Always have this top agenda item. What's going on in the market? A lot obviously has happened since we had our last club meeting in February. Of course, we've had this war going on, and that has basically pummeled the market. It's made trading tough, but it's also made you or forced you to be creative about where you're going to put your assets. Oh, welcome, Kira. We're just getting started, so you made it. Thanks for coming. So with the war, um, it reminds me of an old Warren Buffett quote: "Be greedy when others are fearful, and be fearful when others are greedy." Right now, hey Mindy, if you have the courage and have a long-term outlook, and you have stocks that will probably be in business for a long time and sell products and services that people are still going to buy regardless of what the economy is doing, this is probably as good a time as any to be a buyer. And I know it's tough psychologically when you see the markets tanking because of uncertainty. Markets don't like uncertainty. Welcome, welcome. So even in this uncertainty, you could still pick up shares of companies that are good companies at right now at a discount. So, and you just got to be patient because uh, historically, this too will pass. And I don't think that, at least in from my observation, doesn't look like the country wants to be at war for a protracted amount of time. So what things are getting pummeled that could be, not necessarily are, but could be buying opportunities, could be big tech, artificial intelligence. One thing that's really big are companies that make components for data centers, like Dell, or uh, we've got like semiconductor companies, NVIDIA. Uh, Commodities are getting pummeled, but with the war and uncertainty, even commodities, which were a great trade as a hedge against volatility, like gold and silver, even those are getting beat up right now. And there's something that, or an acronym that I noticed from last month after the meeting, and there's something called the HALO trade. Hard, and it stands for hard assets, low obsolescence. So things that that people are going to need, or that industries are going to need, could be machinery, could be equipment, um, could be could be fighter jets right now at this point. Industrials are sometimes doing pretty well. So stuff that maybe advances in AI can't really adversely affect. Take a look at that. If you know of companies or stocks that have low obsolescence, hard assets, real tangible things, not digital things, then you might have an opportunity there that might not move lower in terms of value, like some of the other things that have gotten beat up, especially tech. One thing that before the war that a lot of folks were hoping on was an interest rate cut. Federal Reserve lowered interest rates a couple of times around the end of 2025. They held off because inflation just wasn't going any lower. It's been kind of stuck between 2 and 3%. But then, if you've already had to fill up your gas recently, then inflation's hitting everybody with fuel. And I mean, I'm not a fan of driving long distances and filling up my tank, so I'm glad I'm going to cities that have a high walking environment. So, and I'm kind of dreading going back to Jackson paying for gas as well, in a car. But that's not just going to affect your pocketbook for gas. That's going to affect other things that rely on transportation. So, ingredients, produce, materials, they're going to need to face high gas prices for transporting those goods to the stores or to restaurants or clothing for retail, for example. And all those additional costs that retailers have to bear, they're going to pass those costs on to you. And so prices are going to go up across the board. Hey, welcome, welcome. So the hopes of the Federal Reserve lowering interest rates are becoming very slim. And it looks like either they're going to keep interest rates high just to try to mitigate inflation, or worse, even raise interest rates to mitigate inflation. And that's what's kind of scary because markets don't like interest rates to go up. And so that might throw a little more turmoil in the markets, but hopefully not. One thing that is also coming in 2026 is the chairman of the Federal Reserve. His term is ending, so there's going to be a new chairman of the Federal Reserve, and he may or may not be maybe 51-50 leaning towards an interest rate cut, possibly, despite what inflation might do. But it all depends on the uncertainty of war turning into certainty with an end. So if oil prices go down, then that might help at least preserve the chance that interest rates might still go down in 2026. Not looking good right now. So always, again, as I always mention to all our members, always be market aware. When you look at, I always look at the news differently and trying to figure out, well, what on the news is, how's that going to affect money, or does it give me an idea to make money? So, well, let's go to our main suggested topic that one of our members suggested. I think I didn't know it had been last month or the month before, and it's a great topic, but I kind of held off on it until today just because we're in tax season. And so let's talk about tax strategies. I haven't done my taxes yet because I hate doing taxes, by the way. Uh, Also, I have no incentive to do it early because I know I got to pay some money every year. So I try to hold off as long as possible. So let me make this a little bigger for you guys on the screen. There we go. So some common strategies. Again, I'm not a CPA. I was actually one of the classes I wasn't a fan of when I was in accounting school, but taxes are still important. So as an investor, and again, one of the best ways to grow wealth is investing in stocks, but the IRS is going to take a cut if you're not intentional with how you strategically plan your buys and sells. So think of this as kind of a primer about how capital gains, dividends, and where you stick your money in terms of tax advantage accounts can help you keep a little bit more of it over time. So if you're smart, which we all want to be, we want to integrate an awareness of tax planning in your strategy. So not just in April, you want to kind of think about it all year. So to keep more. So how are investments taxed? So those of you that are starting to invest in stocks, we always need to keep that tax in the back of our minds. There's basically two ways that we earn income. Either we sell something for more than what we paid for it, or we receive some income along the way while we wait. So the key is, how long did I own the stock? So if I owned it less than 12 months, then and I sell it, then that's taxed at your own tax rate. So if your ordinary income tax rate is higher than a certain income, then that's the rate that you're going to be taxed at. Now, if you are in the lowest income bracket, very low income bracket, and you have short-term capital gains, well, then you'll be taxed at a much lower tax rate. But the real advantage is if you are patient enough and hold on to your stock and don't sell it for more than 12 months, because you get a preferential tax rate. So if you're at a tax rate low enough, you might not have to pay any taxes at all. Or for most households, until you reach a certain pretty high income threshold, your tax rate's capped at 15%, which is not too shabby. So if you make, an average income, then you'll probably be taxed at like 24, 25%. But if you just hold on to that stock for at least 12 months, then that sale is only going to be about 15%. It'll reach 20% if you're like in a pretty high income bracket, but I know not all of us are reaching the pretty high income bracket. And don't quote me on what that is, but we can look it up. I recall it was fairly high in the six figures. So you can dramatically reduce your taxes if you plan to hold on to them longer. That's the nice thing about capital gains. You get to control when you pay your taxes. So if you don't sell, then you don't pay until you do sell. Now, the other way you make money on stocks by instead of selling them higher than what you paid for it, is dividends. So we can actually break down how you're taxed on the dividends too. There is something called qualified dividends and ordinary dividends, similar to how capital gains are in those two different buckets for short-term and long-term. So qualified dividends, you get the advantage of that capped lower tax rate. If you've held onto the stock for at least a year or more for most stocks, then you're capped at, on average, about 15%. If you're in a low enough tax bracket, it could be at zero. But for most households, probably for most of us, 15% for qualified dividends. Now, if it's not qualified, then you're just taxed on that income at your regular income tax rate. So some stocks, or most stocks for just normal company stocks, is going to fall into this qualified dividend rate. There are some like real estate investment trusts which pay a much higher dividend, which is a pro, but the con is you get taxed at your ordinary rate just because the company gets a special deal. The IRS requires real estate investment trust stocks to pay 90% of their income as a dividend back to the shareholders. So they get a tax break, you don't, but in exchange, you get a much higher rate of return from the cash that they pay you. So there's a trade-off there. So if you want to pay lower taxes, look for stocks that are qualified. If you want to get some more cash, then just be willing to pay at your normal tax rate. I mean, I have both, so I'm happy to get free cash for sleeping as much as I can. So now, where are you going to park your stocks? Another thing you can do in your tax strategy is not keep it all in one basket. There are pros and cons for keeping your investments in the right account type. So first of all, and this is where a good chunk of mine are, in taxable brokerage accounts. It gives you the flexibility. There's no limit on how much you put in there. It's just how much you can afford to put in your taxable brokerage account. So unlike, say, your 401k, there's a cap there. And you do pay capital gains taxes when they're realized. So if you sell something for more than what you paid for it in your taxable brokerage account, you pay the taxes for that year. If you earn dividends in your taxable brokerage account, you pay taxes on the dividends for the year that you receive them. So if you have tax efficient investments, and I'm particularly using ETFs as an example. So that stands for exchange traded funds, then and not stocks. So these are like it's like a mutual fund where you got someone or a computer managing a certain basket of stocks, and you get a piece of it, a piece of shares of that managed fund. But you can buy and trade them just like stocks, and that's what an ETF is. So those are tax efficient because even though the fund manager might be trading inside of that fund, you don't have to worry about paying the capital gains of all of the trades that that manager is trading. That's why it falls under the tax efficiency. So you get to control when you pay the taxes because you don't pay the taxes until you sell those shares. So that's why it is. Plus, especially if you're younger, you don't have to worry about that 10% IRS penalty for cashing out before your age 59 and a half. So taxable brokerage account, one basket that's good and gives you flexibility for certain types of investments. Then we have two types of tax advantaged accounts. So there's tax deferred and tax exempt. There's pros in both, actually. So I'm going to jump down to my favorite here, the tax exempt. And employers sometimes offer a Roth 401k, sometimes they don't, but if they don't, then just open up a Roth IRA. It's pretty easy. The cool part is you pay after-tax dollars to contribute to a tax exempt Roth. And the best part about it, which is why it's my favorite, is that the growth, like the share price growth, basically if it grows higher than what you paid for it, fantastic. And withdrawals are tax-free in retirement as well because you already paid the taxes on it. Another thing that I failed to type in here was If you have a lot of dividend stocks in your Roth IRA, those are tax-free too. So that's another big plus. You can just keep on growing. I actually have a Roth that I trade inside, so I try to trade and grow the the investments inside that Roth. And guess how much taxes I have to report on all those trades? Zero, because it's inside the Roth. And then when I finally decide to cash out of the Roth, when I'm old enough, because I'm not old enough yet, but I'm hopefully going to keep that thing growing. Then I'll be able to take that out, and I pay zero taxes on that too, which is actually a cool feature because sadly, even though you get Social Security taken out of your paycheck, every paycheck, and you deserve to get that back because that's your money, the IRS is still going to tax you on your Social Security, which is not fun. But they won't do it until you reach a certain threshold of income. So what if you timed it so where your income is coming from your Roth IRA, say if you're not working, then you would be in the lowest income bracket because that wouldn't be considered taxable income, right? So you get that money out, then you get your Social Security, and hopefully that won't trigger the IRS taxing your own Social Security, which is kind of cool. Again, I'm not a tax. It's good. It's good stuff to know. So the Roth again is ideal if you got stock that's going to grow that eventually you can cash out. Isn't it great to not have to pay taxes on it? Income investing is a big advantage. I've got stocks that pay dividends in there too, and so it's in the Roth vehicle. And again, can't beat zero taxes. Now let me jump back up to tax deferred. Again, pros and cons here. Tax deferred is great because anything you contribute is either a regular IRA or a 401k or a 403b or a TSP that's tax deferred, is it actually lowers your income. So whatever you contribute into these tax deferred accounts, it lowers the amount of income that is reportable to the IRS. And what's great for you is that it lowers how much taxes potentially that you pay in the year that you could make those contributions. And so the theory is by the time you start taking money out of these tax deferred accounts, hopefully you'll be in a lower tax bracket anyway. So you have to pay the taxes once you take the money out of these guys, but hopefully not as high a tax bracket as you are working with right now. So yeah, nice pros, a little bit of a con, which really isn't as much of a con. Then there is another account uh, called a health savings account. The reason why this is called a triple tax advantage account, and a lot of households overlook this, in that the IRS gives a pretty nice bonus incentive for contributing to a health savings account. Not only do you get a tax break for investing in it, like the tax deferred accounts, but it has the same feature as the tax exempt accounts because you could take the money out for medical expenses tax free. So you invest, that money's growing for you, you get a tax break for the contributions, and the money comes out tax free for medical expenses. By the way, if you're thinking about, well, with the Roths, do I have to pay since I don't have to pay the taxes coming out, uh, you can you take the money. If you take the money out before age 59 and a half, there is a penalty. So it's tax free at 59 and a half or above. But if you need the cash, you actually are allowed to take up to how much you contributed into the Roth tax free because you've already paid the taxes on it. The only thing you can't take out tax free early is any of the gains. So just make sure you just got to track. If you need the money, only take out what you've contributed, so that way you won't trigger that penalty. So triple tax advantage account, health savings account, it's taxed when you take it out. You get a tax reduction or in your income when you put it in, and you get to take it out tax free for medical. So that's really nice. When you're taking a look at these accounts, see if you can, as much as you can, try to hold on to it for at least 12 months or longer. So that way you can increase the chances that you would get that nice 15% tax break on your sales. So reduced tax rate on gains helps you be disciplined, especially instead of going in and out, maybe paying extra brokerage fees. Hopefully you aren't, because you shouldn't have to these days. And then you get to control when you pay your taxes. Frequent taxable events from trading. That's what I deal with now. But that's just a way of life. If you're trading, you're going to be paying regular capital gains tax rates. You just try to make it worthwhile by earning a return higher than what you're going to be paying in taxes. But I'm about to go over another advantage that you could take if you're not making money. So, which segues right into number 4, tax loss harvesting. So what if your stock picks don't do that great? We never want to see that happen. You're not going to win all the time. And I learned that especially when I was a really young investor. I call it paying tuition, when I made mistakes and picking stocks that were great but then tanked. So you can tax loss harvest. So what you do is when you have some stocks that did really well and you want to take some profits off the table, look in your portfolio and see if you got ones that aren't doing well at a loss, and sell them in the same tax year. So the advantage is you have a loss which you can offset your gains somewhere else in your portfolio to minimize the taxes on the wins. So overall, the bottom line is it reduces how much taxes you pay overall. On top of that, if you have excess losses, and I've done this before myself, if you have more losses than you have gains that you want to take advantage of, then you could take up to $3,000 of losses, and that can offset your earned income, from your job annually. So again, $3,000 is much, but it can help offset your your earned income as well. So ordinary income, you could lop $3,000 off that the IRS can tax you, and that's one positive you could take away from a not so great stock pick. In addition, if you have losses in excess of $3,000, those losses don't disappear. You can still use them, and the IRS lets you carry it forward. So if I have $10,000 of stock losses in a year, then I can use 3 of it to offset my teaching income, and then I got 7,000 that I can carry forward to years that I do real well, or do well enough to take advantage of the 7,000 loss in 1 year. So and there's no time limit actually to carry forward those losses. So losses are definitely bad, but you can use it to offset income. Now, there is one rule. The IRS is pretty smart, understaffed, but pretty smart. And they know a lot of the tricks that traders and investors try to do. So one thing that decades ago that they tried to take advantage of was, oh, well, okay, I took a loss on this, but I still like the stock, so I'm just going to sell it, offset my income with tax loss harvesting, and then just buy it back. And then it'll go back up because I think the stock's still pretty good. But there's something called the wash sale rule. IRS basically figured that pattern out. You can't buy the same stock within 30 days before or after your sale of the loser. So you got to give it at least, just stick it on the calendar, wait till day 31. And if you want to buy back the stock at a lower price, if you still like it, just wait 30 days to do it. Now here's a little tip though. IRS hasn't come across any rules regarding crypto. So crypto for now is not considered an equity, meaning a stock type investment, so, or a bond type investment, or ETFs or stuff like that. Those are just considered like property assets. So here's how that works, at least until they change or figure it out. The wash sale rule doesn't apply to crypto, so you can essentially uh, build up tax loss harvesting with crypto. Let's say Bitcoin was 120,000 a coin last year. Now it's down to just over 70,000 per coin right now. If you still have faith that in the next crypto halving or Bitcoin halving that it's going to shoot up again, because apparently these are in cycles, then go ahead and take the loss, buy it back within the 30 days, use the loss to offset your income or other positive sales, and then just wash, rinse, repeat. So until the IRS catches on, crypto is actually a loophole with the wash sale rule. Now, if you have ETFs that hold crypto, it's probably not going to work. So the IRS says they may consider it a wash sale rule. So if you have Bitcoin related ETFs or Ethereum related ETFs, then it's probably not going to work. Even though that's the asset that ETF manager trades in, it is not holding raw Bitcoin and Ethereum in your wallet. So if you want to bypass the wash sale rule, go ahead and trade the crypto, tax harvest your losses even within 30 days. Just don't do it with an ETF. Also, tax harvesting, you can actually do it year round. You don't have to wait till the end of the year when you finally figure out who your winners and your losers are. I mentioned qualified dividends just to kind of elaborate a little bit. There is the holding period requirement. Make sure that in order for your dividends to be qualified, you own it for at least 12 months or more. And if you do hold it for 12 months or more, you get the advantage of the long-term capital gains rates, 0, 15, and if you're a high income earner, 20%. So if you understand, like a lot of high wealth individuals sometimes end up paying a lower tax rate than a lot of working folks. That's why, because of how their income is generated. And it's not tax avoidance, it's just tax strategy. That's what they do. There's another thing called buy, borrow, die, where they don't ever sell their stock holdings. They just take a loan out with the stock as collateral, and they can live off the borrowed income with their stock as collateral for the loan. So that's another type of strategy that the wealthy employ. Tax efficient investment vehicles, mentioned that a little earlier, one of the other numbers. So ETFs versus mutual funds, ETFs are considered more tax efficient because if you own a mutual fund, especially in a taxable account, even if you don't sell any of your shares, what happens is the mutual fund manager, to try to increase the returns and the value of those mutual fund shares that you have, they'll buy and sell and trade equities all during the year, during the 12-month period of the calendar year. And they're going to distribute as a dividend some of those earnings from their trades. So even if you didn't sell any of your shares, you might have to pay capital gains taxes at the short-term rates. So those are the higher rates, your income tax rates. So if you don't want to be having a tax surprise, keep your mutual funds in a tax advantaged account instead. But if you want to have the flexibility of the different types of funds, then buy them in ETF form. So if you got an index fund, or at least if you want to keep them in a taxable account. So if you got like an index fund of the S&P 500, or the NASDAQ, or I'm trading ETFs for South Korea because South Korea has some high growth, or ETFs for just the semiconductor. If whatever niche that's out there, there's probably an ETF for that. But even though the fund managers buy, sell, trade the shares within that fund, you won't be hit with the surprise capital gains taxes because of the ETF itself is like a stock. You buy and sell and trade the shares, and you control when you're going to pay the taxes until you sell, just like a stock. So, little table here to help out. So, if we have some bonds or some income vehicles, real estate investment trusts, that's what REITs are. If you're an active trader, uh, keep it in a tax advantage account. So that way, when you finally take the money out, hopefully you'll be paying at a lower tax rate. And it's because generally these are higher income assets. If you got ETFs, which are by nature more tax efficient, if you have stocks that you don't plan to sell for a while, you just want to keep them growing, stick them in a taxable account. It gives you the flexibility of taking out the money when you want. Don't have to worry about the 10% penalty because ETFs and holding stocks long term, naturally efficient. Now, I'll give my little twist just for my own personal accounts. I'll actually have high income stocks or ETFs in my tax advantage and my taxable account just because I like the flexibility of the income from those stocks and ETFs to fund buying more shares of these guys. And probably pretty soon, I'll be generating enough monthly income or weekly income from the income ETFs that I just want the flexibility of just being able to take them out of a taxable account whenever I want and just pay the taxes on those dividends, when it comes tax time in April. So to sum up, track your gains and losses throughout the year, make sure to have good records. If you are short-term actively trading and investing, rebalance with the tax impact in mind, take advantage of those harvested losses. And if you have tax advantage accounts, to the point where you can afford it, maximize contributions as much as you can to the tax advantaged accounts. All right. So we were pretty efficient today. Before we head out, and I'll make sure to send a link to the recording of this video and today's handouts as well. Before we head out, our next agenda item, as usual, is any future topics, and I'm going to pull my little notepad out to write it down, that we want to talk about in future meetings that come to mind. There's a lot of common topics too that are pretty popular. I always welcome, what do we look for in a stock or investing basics. Options are usually pretty popular, but feel free to chime in with your mic if, yeah, I think you guys can do that. Or type in the chat box because I got the chat box open. If you have any topics you want to see for future meetings, either next month or all the way through August. By the way, if you guys didn't know, I'm flying back to North America, so I will be in the States in August for a little while. So the next meeting is actually going to be face to face. Is there any benefit opening a Roth brokerage and 401k? Yes, I definitely say yes. And the reason why is because, well, provided it's not a Roth 401k, because there's a cap in how much you can put in a Roth every year. If you just have a regular 401k, a taxable brokerage account, and if you haven't opened up a Roth, I would definitely recommend diversifying into the Roth bucket, just because you can strategically decide which buckets you're going to draw down from in retirement to minimize your taxes. So having the flexibility of one of those buckets being tax-free can definitely help control the taxes that you're going to be subject to. So because we have, and I didn't mention this earlier in my little handout, because we have the standard deduction, which I think the IRS is going to jack up, or at least propose or the House is proposing jacking up the standard deduction quite a bit to help middle class households. If that passes, then the Roth is going to be even better because you could take the Roth out, take money from the Roth out in retirement. Then especially say if you're a married couple, you can get a significant standard deduction, which probably eliminates a lot of the taxes that you could draw down from your 401k. And so if that is deducted out, then essentially you could pay really low taxes that way. But you won't have that flexibility unless you have both the tax exempt and the tax advantage accounts. So yeah, that for me, the biggest benefit is that tax-free. Now, the cap is pretty low. I think it's like 7,000, or I think it maybe up to 8,000 for the Roth. But hey, if you are contributing the max annually of $7,000 or $8,000, and that adds up over time, especially if you still have a few years left. But yeah, great question. Yeah, I didn't think about that. Yeah, so put money in all the buckets. How does investing in your HSA work? Well, all I know is just from my experience with employers I've had that offer it. So what they do is you can elect, because you have to choose to have like money taken out of your paycheck and contributing to your health savings account. And the cool part is you can use that as like an offset of your income. But then if you do have qualified medical expenses, you can make claims against the balance in your HSA. And there's quite a wide variety of stuff you could spend money on. Like I wear contact lenses, so if I had an HSA, then I can submit a claim for like contact lens medicine or other medicinal type products, and you get and you take that out, comes out tax free, and depending on how you choose to invest within your HSA, you can make those dollars grow. Now, I think that, of course, you probably should look up from like IRS sites for HSA. There may be an expiration date of when you can use them, but I don't think so. But I know you can invest inside your HSA, so that's why it's triple tax advantaged. I know that may not be the best answer, but that's just from what I've read. What is a reasonable amount of money to allocate towards possible investment for a beginner? Oh, that's a good one. And what should they expect? For a beginner, never invest more than what you can afford to lose. So, and that could vary for anyone, but the key though is I always say to any of my students, invest, period. Whether you can afford $5 a week, $10 a week, $20 a month, put in what you can afford. If you get raises in a position, or if you're like me, I'm the king of side hustles. So at any one time in last couple of years, I may have had like 5 side hustles at the same time when I was in the States. So I tried to look less like cutting expenses and trying to think more like increasing income, because a lot of people, when they look at a budget, they focus a lot on decreasing expenses, but forget, well, how do I bring more money in? And what's great about most of you guys is that you're investing in yourself. And so you are investing in a return that can hopefully bring in more income. And that's something that no one can take away, is your knowledge and your education. So you're already going to try to increase your income. But as you do, increase the amount that you can afford to put in each month. Again, reasonable amount is, I always say, what you're comfortable with in your particular budget. And I know a lot of folks that I've met, even when I used to do workshops at the women's shelter downtown, in downtown Jacksonville, because I did a side job with a nonprofit to teach financial literacy. And a lot of the women there, I encouraged them. I go, yeah, hey, even $5 a week, it adds up over time. If you are disciplined, it will grow. And they did it. And it did grow. And the more you put in, the less likely you're able to touch it, because you know how much you sacrificed to get to that point. Are there ways to know what a good investment looks like? Yes, there are. Matter of fact, I can actually revisit that in the next meeting, because that's probably one of our top 2 popular topics that our members like to talk about. So yes, I have a great handout I've already made that I can actually update if I see an update. So some ways to know, especially if you've taken my finance classes, there's 2 types of ways to look at an investment. And I'm going to stick with stocks to make it a little simple. You could look at it from a fundamental standpoint, like what do they do? Are they making money? Do they make products and services that people are going to buy regardless of what the economy is doing? Which means they're probably not going to go out of business anytime soon. Do they pay a dividend? And then there's a technical way of taking a look at it, which is a little more complicated. I only talk about that in the investments class. You could take a look at a chart. You can take a look at patterns of how a stock moves, and you can make a trade based on that. But if we're talking about true investing is always long term. So it's different from trading. So if I stick to investing, then I want to take a look at their cash flows. So is the company generating more and more cash each year for its investors? Are their profits increasing regularly? Do they pay a dividend? So that's a nice bonus. So as you wait for the stock price to go up, am I getting paid cash every quarter or every month along the way while I'm waiting? Is the dividend sustainable? And can they afford to keep paying? And there's a way you can calculate that as well, at least an idea for that. You can look at the top line. Is their revenues going up? I mean, you take a look at NVIDIA, they have ridiculous revenue growth. It's super impressive, which is why the stock has taken off over the last decade. They used to just be known for video game cards. Now they're essential for artificial intelligence and self-driving cars. So avoid the hype is one thing you don't want to do. Try not to follow the memes, because by the time someone's made some money on a meme stock, and by the time you hear about it, you're going to be left holding the bag after they've gotten out of the stock. So look for ones that stand the test of time first. A couple of things you can do, Teresa, is you can Google, and I love sharing this one even in my classes. You can Google a couple of terms. I'm going to type it in the chat box here. Dividend kings and dividend aristocrats. So what dividend kings are, and these are good places to start. These are companies that have not only paid a dividend every single year for 50 years straight, but have basically given you a raise in that dividend every year for 50 years straight. It's a small list, but it shows consistency. The dividend aristocrats are similar. It's a longer list, but these are companies that have paid a dividend every year for at least 25 years straight and have given you a raise every year for 25 years straight. And a lot of the names on these lists are ones you've probably heard of, like Johnson and Johnson or Coca-Cola, Home Depot, Lowe's. So a lot of very well-known names, and a few that you've probably never heard of. There's some that make sense if you think about it, but most people don't even know of because they're not sexy enough. Like think of utility companies, water utility. People are going to need electricity and water, and these companies have built-in customers, and they're not going out of business because they're kind of like their own little local monopolies. But they're nice investments because they are known for consistently paying you every single quarter or every single year. So Coca-Cola is probably not going to go to the same anytime soon. Although I actually have a preference for Pepsi just because they make more than just drinks. uh, so those are good places to start, especially for beginners. Actually, um, Pepsi was like the third stock I ever bought. So yeah, I'm glad you like those, and I'm always happy to share more. See, since you, I'm not sure what that one means, but all right. Any other suggestions or questions? These are good questions, by the way. All right. What I'm going to do is I'm going to go ahead and post the video online so that way you guys, and those of you that weren't able to make it, that are watching this, I'm glad you're able to see the video. It may give me a couple of days. I'll just have to render the video in WebEx. But for everyone, as long as I have your email, then I'll be able to uh, if you're on the email list for the club, that is, then I'll be happy to send the handouts to you because I always send the handouts right after meeting to those that are on the club's email list. If you are not, oh, thanks, Teresa. If you're not on the email list for the club, that is totally okay. If you're coming from my class, then thanks, Mindy. If you're coming from my class in the coffee shop board, just send me a message in the coffee shop board with your preferred email address, and I'll make sure to not only add you to the club email list, but I will also make sure you get the handouts too. So great. So I'm glad you guys like the topic. I just figured it's just perfect since we're in tax season right now. All right. Well, thanks for coming, everybody. And I hope to see you in person at the in-person meeting next month. Take care. Stay safe, everybody. Thank you, Jir. Thank you. Thank you. See you, William. Thanks, Camilla. Thanks, Mindy.